Today I'm going to be talking about seller financing and blended rates and just how do you make that work when you're trying to structure a loan. Let's say you're trying to buy a piece of property and the seller wants cash and you have some down payment, but you can go get a loan. You can get a private money loan or you can get a loan from an institution. And let's just maybe an institution will only give you a 50% loan to value, or maybe 60%, which means that the seller would need to carry a second. And some banks will allow a second behind their first and some won't. So financing is a big issue, and we want to know how to look at those rates and to move those rates around, to switch the first and the second around and see how we can come out with a rate that will give us a good cash flow, which will increase our yield, whether the price of the property has to come down, whether the rates need to be changed or moved, the term can be changed. And so I've developed this spreadsheet so that I can look at a loan and see exactly maybe how it could work if the buyer and the seller and the lender could all agree on how this would work. And of course, banks and institutional lenders have their rules and their regulations that they have pretty well set. But private money lenders, seller financing, owner carry, as long as the buyer, the seller, and the private money lender or whoever's putting out the funds can agree. So let's get into that spreadsheet and let's see how it works. This is an Excel spreadsheet that I have developed so that I can change things around, and you can see I've already got it filled in. It's with a deal that I was working on some time ago, but today I'm going to change these figures up just so that you can see how the Excel spreadsheet works. And you can develop a spreadsheet like this that may suit your needs and show your buyer and your seller and maybe your lender how that these things could work, and maybe you can come to an agreement on how you would structure the financing. And so today there is many variations on how you're going to pay that cost of funds, like adjustable rate mortgages, down payment assistance programs, HUD, FHA, VA. All those have different ways that you can pay the interest. And this seller financing owner carry spreadsheet that I have developed is just another way of how you can minimize the cost of funds and maybe structure your deal that would be of benefit to all the parties involved. So I'm going to change some of the rates and the terms that you can see how the spreadsheet works. And you can see that I've got do not change the highlighted formula cells. If you're familiar with Excel and know how to do the formulas, then go ahead and change them. But otherwise, I've got it down so you don't have to look too hard to find what you can change to manipulate to get a different outcome. So I'm going to start up here and I'm going to change the price to $490,000 just so that we can see how it works. And let's say, whoops, that's $49,000. I'm going to change it to $490,000. That makes better sense. And let's say the seller will not go with a 10% down payment. That's pretty slim. But let's say that the seller will go with a 20% down payment. And so now we've got a loan. If I put this up here at 1 and this at 0, we can see that we've got a $392,000 loan and our payments are $2,350 a month. And now we want to know how that would work. At 6%, looks like a $45,000 NOI. If that were true, we're going to change that you would have a cushion of 1.60. So we're going to split this loan up. We're going to say that the seller or the lender will allow a 60% loan, put that in as a decimal, and then behind that would be a seller carry second of 40%. And now one thing about this spreadsheet and this loan is that the loan has to come up to 100%. I mean, you could use 60-40 or 50-50 or 70-30 or 30-70 or 40-60, but whatever you use or decide to do, it has to add up to 100% because that's 100% of the loan. So now we can see that my blended rate is 4.60. But so let's change some of the rates. Let's say the first mortgage lender wants 9%. So that brings it up. That makes our blended rate go to 6.4. So I'm going to change the rate over here on the second. I'm going to change that rate to 4%. And now you can see that I've gone up to a 7% blended rate. That's better than 9%. But my debt coverage ratio is now at 1.42. My debt service is $31,000. So now I'm going to change the NOI. Let's say that $31,692, and we'll see what that does. Now that comes down to where that is break even, 1%, 100%. And what DSCR means that your net operating income, which must be true, must be factual, can cover 100% of the debt, which if anything went wrong beyond that, you would have to come out of your pocket with money to be able to replace water heaters or windows or faucets or something like that. So every lender usually wants the buyer to have a cushion because the lender or the seller does not want to foreclose on the property, so that cushion is built in so that you can have a profit and you'll be able to take care of any unexpected repairs. And also, the buyer should want a cushion too, because you don't always want to be operating a property on a break-even basis because things just go wrong and you'll be coming out of your pocket with extra money, and the only thing you've got is you've got depreciation and hopefully appreciation working for you, which is not a good scenario because those things may or may not happen. So let's change our net operating income to say $40,000. And let's see how that looks. That's $40,000. And that gives us a 1.26. That means we can cover the debt 100%, and we've got a 26% cushion. Now, most lenders, institutional lenders and some private mortgage lenders, and buyers and sellers should also want you to have a cushion. That's a pretty good cushion. Now, if you go up beyond that, your cushion even gets better, which makes the lender more comfortable. But now we can manipulate some of these figures and see what we can do. Let's say if we drop the term down to 240 months, 20 years, and now our debt coverage ratio went down to 1.16. And let's say we drop the second mortgage down to 3, and we decrease the term to 240. And now we've got a 12% cushion, and we haven't changed the net operating income. We're just manipulating the parts of the loan to see how we can get a blended rate that works for us. And so we've got a first mortgage of 9% that satisfies the first lender, and then we got a second of 3%, and now we're trying to figure out what is the best way to structure the loan to make the cash flow work good and for you to be able to make a profit and the seller to get their funds and for the seller to move on and the buyer to make the profit. So that's the blended rate formula, and you can manipulate the cells and you can see how it works. It works pretty good, and it gives you some options that you maybe can discuss with the buyer, the seller, or the lender. But you can look at a property and determine if it would fit your needs. So, thanks for watching.